Be Wealthy and Smart, episode 1217.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about how this is a week of heavy economic data, which could mean more volatility this week. On Wednesday, we have a very important report coming out, which is the Consumer Price Index. It's going to tell us what's going on with inflation. And right now, we kind of have an air pocket where there's not a lot of news happening. So the markets are really susceptible to any kind of news swinging it one way or another, and in some cases, pretty dramatically. Now, one of the Fed members came out today and said they think that a couple more hikes of interest rates will be appropriate this year. They also said it might be one, it might be two, it might be less. They don't know. So again, the uncertainty leaves the market not really liking that information. And they're going to be data dependent on what that report says on Wednesday. So there probably will be volatility if the market's thinking one thing and the report comes in another way. Also on Tuesday, tomorrow, we get the UK jobs data. On Thursday, we get the producer price index. So more data on Thursday that is going to give the Fed some clarification of which way interest rates should go. In the meantime, interest rates are volatile and are trying to find what the right level is for now and in the future, because we have this inverted yield curve situation where longer-term rates are actually lower than short-term rates. Interest rates are expecting a recession in the future, either later this year or next year. As I've been saying, I do see rates going lower, likely by the end of this year into next year. So if that's the case and a recession starts to hit, we will start to see interest rates come down. Now, I've been talking about the time lag just about since the Fed started raising interest rates, but there is a time lag between the time that the Fed starts raising interest rates and when they actually start working. Now, we've had 10 interest rate hikes since the Fed started their campaign, but they did it so quickly that we haven't had enough time for those interest rate hikes to really do their work in reducing inflation. Now, this article on CNBC had a particular paragraph that caught my attention. It said, Fed policy is seen as operating with a lag, meaning that the 10 rate hikes since March 2022 likely haven't worked their way through the economy yet. And that's exactly what I've been saying. Because of the lag time, it takes 12 to 18 months for those to really work their way through the economy to slow it down and to get inflation at a lower level. Now, the Fed's shooting for a 2% level, and we're still way above that, but it takes time for these interest rate hikes to slow things down. This was said by Chicago Federal Reserve President Austin Goolsbee, who said there are some modest increases to come, meaning of interest rates, but we've done a lot of the lifting, and now we're waiting for the impact. Yeah, that's exactly right. We're waiting for the impact. And one of these days, that report is going to come in with a whammy that inflation has dropped quite a bit more than people foresee. And that is going to create some more volatility in the market. So I'm just saying that's out there. It may be this week that that happens. We also have 8 Fed representatives speaking this week. So we're going to be getting a lot of jawboning. Yes, I use the word jawboning because that's what the Fed does. They talk interest rates up or they talk interest rates down. And just by what they say and what their expectations are, interest rates respond to that and the market responds to that, which affects bonds, which affects ultimately stocks. But the other thing we have going on this week is the beginning of earnings season. Now, we had a lot of companies tell us that their earnings were going to be lower than expected. And so we may see that that is in fact what happened. And if we get bad news on earnings, that could also cause the market to continue to pull back. According to a Zero Hedge article, it said global stocks have been on the back foot at the start of the second half, amid concerns economies will buckle under high rates as central banks keep up the fight against rising prices. U.S. Treasury Secretary Janet Yellen said at the weekend she wouldn't rule out a U.S. recession, noting inflation remains too high. Nicolo Botchin, global head of fixed income as Azimut Group, said on Bloomberg Television, everyone is looking at inflation or has been looking at inflation for a long time. Now it's time to look at growth. But Nigel Green, chief executive of DeVere Group, said with second quarter earnings season starting this week, investors should expect volatility to pick up in the weeks ahead. Markets are bracing for what could be the worst reporting season since the end of the pandemic, Green said. In the last quarterly earnings, there was a lot of negative guidance. We're likely to see this having turned out to be correct amid the brewing of a perfect storm of several major economic headwinds. And that's what I think we could be headed for, is the continuing of the June correction that I said had started, and we're still in the midst of this. In spite of some short-term bulls and bull calls out there, I think we have the ability to have some volatile surprises on the downside should companies not meet their earnings expectations and if they continue to guide lower in what their future earnings will be. So again, we have the lag time out there that we're going to see a dramatically lower CPI at some point. It may be this Wednesday, it may not be this Wednesday, we'll see. But we definitely have a lot of volatility headed toward us this week as we have a schedule of heavy economic data. And that can tend to swing interest rates and swing the stock market quite a bit. So I wouldn't be surprised if we saw some pressure on the downside with the Fed making comments about raising interest rates more or earnings coming in weaker than expected. So keep your long-term perspective. This is something to hold through and may ultimately provide a buying opportunity. Still bullish for the longer term. We're just going to have some volatility to get through here. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.